All right, we are recording. Well, hey, y'all, thanks for joining us. We are doing our third quarter call talking about what's going on in the real estate market nationally and locally. So we've got a lot to go through. I'm going to give you my favorite quote from Warren Buffett these days. We'll talk about financing with Drew Blakely, talk about sales trends with Sean McDonnell. I'll talk about rental trends, and then we'll talk about the big, beautiful bill with Justin Shore. So my favorite quote right now is be fearful when others are greedy and be greedy when others are fearful. I don't know if you guys know this, but Warren Buffett or Berkshire Hathaway just bought $1 billion. They spent $600,000 buying shares at D.R. Horton and then $400,000 at Lanier. So they think real estate is a good thing right now because, as you all know, we are in a different market. So we're trending, we're in a buyer's market now, and I just kind of want to highlight the average phases of these real estate cycles are 3 to 5 years. So just like start to prepare yourself for things to kind of be like this for longer than we all probably anticipate or want. But it's a great time if you're a professional investor running numbers. You can still find deals that make sense. So with those highlights, I'm just going to hand it over to Drew to talk about what's going on in the finance world.
Yeah, thank you, Schuyler. I know a couple of you guys on the call, but just wanted to give a little bit of background information before I dive into kind of what's happening in the world of mortgage. So I first got into real estate at the end of my time in high school. My dad and I began flipping houses together, and that's ultimately how I came out of college debt-free. And so paid for college through house flipping, and then I got married. My wife and I were newlyweds with very little money and decided that house hacking is how we were going to buy real estate. So we Airbnb'd a bedroom of my house, and that kind of launched into now my wife and I own four single family properties, 3 of which are rentals, 1 of which is our primary residence, and began my mortgage career back 5 years ago now, crazy enough, and really, really love what I get to do because I get to help investors, whether they're brand new investors looking to buy their very first house hack or they're seasoned investors looking to buy another property in their portfolio. I love the whole array of buyers I get to work with. So the advantages of working with, that's a little bit about my backstory, a little bit about the company that I'm working with. It's a small company based out of Washington, D.C. called Loan Steady. I think that the biggest thing that you want to have as an investor specifically is a company that is adaptable and a company that has very little middle management. As investors, we have a lot of out-of-the-box situations, a lot of unique scenarios. And so for a company to be smaller and for you to be able to get answers quicker and for it to be adaptable, that's a big thing. The second thing is a lot of times the bigger the company, the more middle managers that you're going to have, and ultimately the more hands in the cookie jar per se, and your bottom line interest rate is going to be inflated. I also take a lot of pride in just the amount of connections I have with not only investors and realtors in the area, but also with other mortgage professionals. So if you call me, I would love to think that I'm a one-stop shop, and not because I have every product, but because I would know somebody who will have the best product. And so that would be my ask, is if you call me and I don't have the best product for you, I will find somebody who does. So that is myself. That is my company.
Well, and Drew will just give you guys the best rates, and he won't BS you. That's like
the best
thing for bottom line investors.
Absolutely. Now, lot of chit chat about what is happening in the world of mortgage rates. I've got an influx of texts about refinances and what is going on, and so wanted to tell you for the first time in 2025, at least, that we have made serious progress in the right direction. And quite honestly, it's been a massive market rally over the last 72 hours. And so what had happened was on Friday, the jobs report came out and the economy is not looking great, which would likely spur on 2 additional rate cuts in definitely in September and October is what we are thinking. And so with that being said, as of yesterday, when I pulled the most recent rates, we're all the way down to 6.3% for a conventional mortgage. That's going to be on your primary residence. Investment property is hovering in the high 6s now without paying any discount points. And then for the first time in goodness, maybe 16 months, I'm seeing the rate start with a 5, and that's for the FHA and the VA loans. So rates are substantially better than they were in Q2. I'm hoping that this rally is not temporary, but something that is sustainable moving into the back half of this year. The Federal Reserve is meeting in September and in October. I don't know how familiar you all are with prediction markets, but things like Polymarket and Kalshi and things, they're saying that as of right now, there's an 85% chance that we'll get a 25 basis point cut in September. And then they are predicting we'll have about a 60% chance of getting a cut in October. So what I want to be very, very clear about is, yes, the market is absolutely rallying. Yes, we are absolutely thinking that later this month we will get a Federal Reserve rate cut. What I want people to understand is that mortgage rates are not directly impacted by what the Federal Reserve decides in September. The mortgage market is based primarily on kind of a 60 to 90 day future. And so the loans that we are pricing today are really kind of already incorporating what we think the Fed's next 2 meetings will hold. And that's why I think we saw such a big drop in rates this past Friday, was because things looked really favorable for a rate cut come October. And so we're already pricing in a projected rate cut at this point for that meeting in October. So I just don't want you guys to say, hey, if I hold on until September the 17th and Drew tells me we're getting a 25 basis point cut, that my VA loan is going to go from 5.9 to 5.75. That is not how that works. Again, we're pricing in future, what we're thinking is happening 90 days from now, and they're not correlated 1-to-1. But again, good news, happy to report on all of these things. And if you guys have questions after this call or whatever, I think Schuyler will provide my contact information. I would love to chat more.
Yeah, for sure. Drew's a wealth of knowledge, and we'll do math on like, should you buy the rate down? What are your plans for the property? What makes most sense financially to get you the best ROI? Really love working with you, Drew. Thank you. So guys, next up, I think you all know Sean, so I'm going to save the intro this time. But he's a great friend, great investor, and a great real estate agent. So you can really trust what he says.
Thanks, Schuyler.
Yeah, man.
Hey, everyone. Yeah, I'll be quick so we can get to the main event, Justin and his big tax savvy brain. But that man literally has saved my family hundreds of thousands of dollars in taxes owed to the government. So yeah, he's awesome. But yeah, so the sales data, national versus local, is kind of a tale of 2 cities. So I don't know how much news you all watch, but there's lots of panic seeking clickbait saying we're in like this real estate inflation or like the market's going to crash soon. And there are areas where that's happening, but I'll tell you, so nationally, more inventory overall, like more buyer advantage. This is like across the country, active listings have grown for 22 months straight. So there's more and more houses hitting the market and fewer are selling. And I thought this data point was interesting. 57% increase in like delisting. So sellers listing their house and then it's sitting and then changing their mind and pulling it off the market. Buyer leverage increasing. So there's over 6 months of inventory in some big city markets like the ones I listed there, which a lot of real estate nerds will say if it's over 6 months of supply, then it's like a strong buyer's market. So buyers have more leverage, but still the median home price is still increasing on average. So you can see that's been a trend for a while now, which is kind of conflicting to, a lot of the doom and gloomers. But next, so there is, positive signs, I would say, depending on, I guess, who you are, but 25% surge in mortgage applications for purchases compared to last year. And, but I would say most realtors are still kind of cautiously optimistic. Only 16% expect buyer traffic to increase in the coming 3 months. It's also entering into a slower time of year, where fewer transactions happen in the winter time. But locally, I just have this chart, try to just make it simple, but we're seeing pretty positive price appreciation still across our 3 markets. So these data points are like year to date. So through August, New Hanover County is up 2.2% compared to like the same time last year. Pender County has seen, a pretty decent appreciation. And then same with Onslow County. Homes sold is, a little higher in Pender County, a little less in Onslow, or a little higher in New Hanover, a little less in Pender and Onslow. And then days on market is still ticking up. But yeah, I'll tell you, I was just looking at houses in these 3 counties that have been on the market for over 6 months, and almost 50% of them were over $1 million. So the higher price listings, especially like North Topsail Beach, if you're familiar with our market here, like there's a ton of inventory in North Topsail Beach right now. A lot of the over $1 million properties are just really difficult to sell for sellers right now. So yeah, if you have individual goals or individual questions, please reach out. And yeah, it's good to see everyone.
Yeah, thanks, Sean. It's always fun to see how everything weaves together what rates are doing, what home prices are doing, and what rents are doing. So rents have fallen nationally about 0.5% year over year from June to June. But in some places they've fallen a lot more. So in Austin, they dropped 6% year over year. But even though they've dropped, right, if you look at the trend of things, we're still generally up because we keep printing so much money. Locally, there's a lot more supply than demand. So I'll kind of skip forward real quick to what rates are doing here in Eastern North Carolina. So we've dropped between 2 and 10%. Depending on the specific area or the rental type. And that's a pretty big gap. And that's literally just because the products are now like very different, right? So if you have a townhome, you're competing with big apartments. If you have a single family home, you're not. So there's just a big diversion where the last 3 years, a 3.2 townhome and a 3.2 single family home, there was still a gap, but it wasn't as big because there weren't as many apartments that came on board. So yeah, the trends are still good. We still have people moving here, but we definitely have a lot more supply, right? So people are holding on to their houses, and because of their interest rates, they're moving away and renting their house out. So there's just a lot more rental supply everywhere from Jacksonville to Wilmington. Kind of going fast because I'm super excited to get to Justin. He knows a lot, and I learn so much from him every time we do a call together. But I always want to like highlight, what do we do in this market? And if I am trying to build wealth through real estate, what do I do? Sean mentioned the doomsdayers, and the news is full of them. But if you really have good numbers, guys, even though rents are kind of going down, interest rates are up, and home prices are up, you can still find good stuff that cash flows. You just got to really focus, which is why we do these calls. So if you go look at Sean talking about median price, it's not interest rates do make things hard, but the hardest thing is if your prices are going up and your rents are stagnant, that's what's really squishing your returns. So know that information. And if you're looking, maybe you change your criteria. Where I was investing previously in Wilmington, now I'm going to focus more on Onslow County, or maybe I'm going to find a submarket in New Hanover County, like Castle Hayne, and invest there because the price is down and the rents are still up. So your rent to price ratio is higher. So there's a lot of stuff, a lot of deals that can be had. I've bought 2 deals this year already. Because if you look, you can find stuff. I got a friend that bought a house for 80 grand last week that was listed for 165. So it's really a great time, I think, to be alive. But without further ado, the thing I'm excited to talk about is the big, beautiful bill, guys. Justin Shore's with the real estate CPA. If you guys are Bigger Pockets fans, yeah, I learned so much every time he talks, and he is the most knowledgeable CPA I know, or the accountant I know. So Justin, over to you. Thank you for your time.
Yeah. Thanks for having me on. So I think I have control on these, right?
Should, yeah.
Yeah, there we go. Perfect. So yeah, there's a ton of stuff packed into this bill, you guys. I'm like not going to cover all of it, of course. But like mostly focus on like more like the real estate aspects of all of this. But there's a few of these I'll throw in here too. There's just like reading a lot of questions on this, even for like other types of businesses. So the first big one here was the no tax on tips. I was actually really surprised they were able to pass this with this in here, but hey, it works. There are limits on this as far as I've got here. Can I like draw on this? I think I'm used to Zoom, so yeah, that's okay. I don't think that I can.
Should be able to click in there.
If you click into the is there like a drawing capability on there somewhere? I don't see one.
Do you see that?
Do you just click and drag?
Yeah, you have like a green dot when you put your cursor over it.
I do not. A green dot. Is there? Yeah, that's okay. No worries. Maybe it's nope, that's Gemini. You did something there that made it work for me. Perfect. You can annotate on the screen. Excellent. Okay. And then undo. Perfect. So there's income limitations on here, like 300,000 married filing joint. So not everybody can specifically take this. The biggest question we've got around it is just like, if you own your own business or something like that, can you restructure like your compensation or something like that to start like taking tips? For the most part, it's no. Like it has to be like for the most part businesses that are like regularly in the business of getting tips, and things like hair salons, nail salons, restaurants, valet services, things of that nature. And this one is one of the few that like it does expire at the end of 2028, so it's not a permanent thing. They could extend it, but as of right now, it's will be set to expire in 2028. But the income threshold there is also going to eliminate it for a lot of folks, unfortunately. And a lot of the stuff like over here is kind of a little bit more technical, but basically what they did to like prevent just any businesses like outside of normal, like the tip norms, like accounting firm, for example, like providing professional services, you can't like, restructure, like property managers can't restructure it to somehow include getting tips. I don't know if you could figure out a way to do that. That'd be pretty creative, but so that one did get passed. That one's in there. Be really helpful for some folks. The next big one is not exactly real estate related that I included in here though too, is like the no tax on overtime. Similarly, like we got income thresholds on this one, 150, 300,000 married filing joint. And they limited it to only $25,000 between the two spouses that could actually qualify for the no tax, like on the overtime pay itself. So potentially, helpful for some people.
And that's just like ordinary tax, right? It's not
right. Yeah. So like normally, your over time would just get hit with like your ordinary marginal tax rate, like your 22, 32, 35, 37% rates. But as you see you wouldn't get up to 32% because of the income threshold and still be eligible for it. But it's important to know too that it is that it's not the way that they wrote this too, and that this is like kind of misleading when they said like no tax on overtime. So like if you get $10,000 overtime pay, it doesn't mean that you pay no taxes on the overtime pay. It's that you pay no taxes on whatever the 0.5x, like the additional chunk. So like the when you get like time and a half, for example. So it's not necessarily like completely tax free. It's just that you're getting it on almost kind of like whatever the bonus amount is, essentially. So all right, so let's go ahead and go to this one. I have included this one in here because I've gotten a lot of questions around this too, and because there was a ton of information slurring around like in the news about this particular deduction, and not to say that it's not a good thing. It's just not as big or as extensive as people were I think assuming that it would be. And it's all this no tax on car loan interest. And it was confusing a lot of people, especially that had established businesses like rental portfolios or, other active trades or businesses, because this is completely independent from business vehicles. Like if you have a vehicle that you're using inside of your business and taking business deductions, that's a completely different like code section that governs that. But those, like you've been able to potentially deduct auto loan interest on like if it's a vehicle used in your business for a very, very long time, like for decades. This one is specifically for like personal vehicles. So that's where like it's kind of unique is if you, again, it's subject to these AGI limitations. So it is kind of like on the lower income bracket, like taxpayers. But if your income is below the 200,000 married filing joint, you can deduct some of your loan interest on your personal vehicles. And yeah, sorry, go ahead.
Do you have to itemize or do that? Or can you take the standard?
No, that's a good question. You don't have to itemize. It's going to be an above the line deduction.
Okay.
Yeah. So even if you don't itemize, you'd be able to do this. What Schuyler's referring to, if anybody's not familiar with that terminology, that's where like you get your standard deduction, or you can take the itemized deduction, but your itemized deductions obviously need to be higher than the standard deduction for it to matter, like for you to want to itemize deductions. And that's your personal residence property taxes and mortgage interest on your primary residence. And then there's potential to have medical expenses included in there. It's super rare for that to actually work. Your medical expenses have to be like astronomical for that to work. There's a few other random small items that are in there, but the big ticket ones are interest on your primary residence and your property taxes, and then also your state income taxes as well. But yeah, so this one would be separate from that. They did like they put some restrictions on this, and that like original use has to start with you. So like you have to be the original like owner, the first owner of the vehicle. So like it's got to be a new vehicle. And then it's got to have final assembly in the United States is the real big key kicker there. So there are some vehicles that are like partially assembled like in China, and then they're finished up in the US. So they don't have to be completely solely assembled in the United States. But they're putting, obviously like this, the whole incentive behind this is to get people to buy American-made vehicles, essentially, is what they're driving at. No pun intended. So, but yeah, a lot more availability as far as like if you're doing a business vehicle, there's a lot more deductions that you can take on those, and you don't run into as many of these restrictions like it having to be made in the United States, stuff like that.
Yeah, cool. I didn't know that.
Yeah, so and we're expecting that they're going to have some it's going to put a little bit of extra reporting potentially on the lenders, because they're going to have to most likely include some kind of disclosure, some kind of statement on the
like a 1098 for mortgage interest.
Right, exactly. So I don't think that's been ironed out quite yet as far as like what the reporting requirements are going to be for it. So this is another one, kind of non-business related, but if anybody's having kids this year, we have a lot of newborns at the firm this year. So a lot of our staff is taking advantage of this. That's the Trump accounts. And that, yes, they did put his name like on the name of the accounts. And essentially what this is, it's very similar to the idea of like a Roth IRA in a way. And the way that it works is you can put up to $5,000 into one of these savings accounts for children. And the growth that it experiences inside of that account will grow tax deferred. So that like when the account itself is generating hopefully investment returns, that income's not going to like pass down to the kids or whatnot. So kind of like an IRA in that way, in that it's tax deferred. And you can put up to $5,000 a year into these. You do have to like actually open it and fund it. If you have a child that's born this year, you get $1,000 credit towards like the account. And the last time I checked, they were saying that was going to be like a tax credit, that it wouldn't actually just be $1,000 put in the account. And that's only for kids that are born this year. Now, if you have kids that, like I've got an 8 and a 10-year-old, if you have kids obviously that weren't born this year, you are still eligible to contribute to these. The kids just have to be under 18 years old, which got notated up here. So as long as they're still minors, you can fund the accounts. You just won't get that bonus of for $1,000.
Do you think they did that because our birth rate's declining, or they did that because they want to stimulate investment dollars in the economy?
Yeah, my theory is that, and just, from the financial perspective and not necessarily the political perspective, I guess you could say, is that this would boost to some degree the stock market a little bit.
Yeah. Okay.
Because now everybody's going to have incentive to put these dollars like into these kids' savings accounts. The reason why I say that is the requirement is it has to go into S&P 500 index funds. It can't go into anything else. So that's where it's different from like an IRA. You can't put it in anything but the S&P 500 index funds. And they're saying like it obviously is aimed at making it as conservative as possible and like more or less, guaranteeing returns if there is such a thing. But the other interesting thing on this that I think is cool, if you is you can the contributions don't have to be made by the parents; they can be made by family members as well. Now, there's no deduction for putting money in the account, so that's the other way that it's like dissimilar from an IRA. But like other family members can fund these accounts for like grandchildren or nieces and nephews and stuff like that, since there's no deduction attached to it. But what is interesting is businesses can fund these accounts for their employees' kids, and in that case, it would be deductible. Like the business, like the employer, would be able to deduct that as a contribution. Oh, similar to how like when an employer has like a 401k match, they get deduction for that. So we were kind of nudging our CEO over here at the firm, like, hey, that's a great reason for you to want to fund everybody's kids' accounts. But it, I know from a serious standpoint, like it would be like a kind of a neat benefit or whatnot to be able to contribute or whatnot to any of your employees' kids' accounts there. Main thing is like you can't take distributions. Got these down here before the kid turns 18. The idea behind it is that this money will grow tax deferred in that account, and then when they like get out of high school or whatnot, they can utilize the funds for qualifying endeavors like paying for tuition. And there is also like an exception in there. They can either use it to go to like, traditional university, but they can go to tech school or trade school or something like that too. And there's also an exception there where if they don't do either one of those, they can potentially use the money to start their own business as well. This is kind of like seed money for whether they become an entrepreneur right out of high school or they're going to go to some kind of secondary education or something like that. If they pull it out for just any old reason, like they want to, I don't know, buy a car for themselves or something like that, it's taxed upon like the distribution. So again, kind of similar to an IRA, like in that regard. But they do have the option to roll it over to a Roth IRA as well. So that's a nice perk. So
cool.
Right. And the fact that they can't access until they're 18 kind of like guarantees that they don't use it for silly reasons. Or before they're at least like old enough to make smart decisions with it.
Hopefully.
All right, so the big kahuna, right? This is like the most exciting probably piece for all of us real estate investors, is the reinstatement of bonus depreciation. 168K is where that's housed, but everybody just of course calls it bonus depreciation. The beautiful part on this is permanent. They originally were going to have like some kind of a sunset date, like 2028, 2030, something like that. But they were able to pass this and make it permanent. So for any of you who are like aware of the last few years where we had this environment where starting in 2023, bonus started going down. It was 100% for about 5 years. And then 2023 started going down 20% each year and was originally scheduled to go down to 0% by 2027. So 100% back permanently. Now, permanent means it's, unless they pass another law in the future that changes it. So they can change it down the road. I don't want to say like it's guaranteed, but at least for now, it provides a lot more, planning perspective on that, of not worrying about what's it going to be next year, what's going to be in 2027, things of that nature. One of the tricky things with this, and I hate it when they do this. They every once in a while will do this. Almost everything in the tax bill went into effect on January 1st, like most of the stuff. This one though, bonus depreciation, the property has to be acquired and placed in service after January 19th. So January 20th and going forward. Why January 20th? That was inauguration day. So a little bit of a political thing.
So Justin, what's the difference between placed in service and purchased? So I closed on something. It's like January 10th.
Yeah.
And it's a big renovation project, and it was rented out after January 19th. So because it was rented out, my thought's always been effective is when you first list it for rent.
Yeah, unfortunately, the way they wrote this provision is if you acquired it before that date and you didn't have it wasn't ready, like it wasn't placed in service until after, you're subject to the original 2025 bonus rate of 40%. If you acquired it before. And actually a little bit like further, I don't have all this detail on the slide, but I have a little bit like kind of a reference here to it. Is like, if you were in what is considered to be a binding contract before this date, before January 20th, and you closed after January 20th, even if the closing came after January 20th, it is subject to that 40% rate. Now, the big question is what the heck constitutes a binding contract. And, there's some like legal questions to ask in there on like each state's a little bit different on what the legal language would consider to be binding. But for the most part, most of the contracts that I have looked at, because we've had a lot of people that are in this boat where they were either under contracts, in December, didn't close till February for whatever reason, because of diligence periods and things like that, is that if you were pretty much locked in to it, like you couldn't walk away without some sort of like major penalty, like forfeiting a huge escrow, good faith deposit or something like that, it could potentially be a binding contract. But if you had like a nominal escrow amount, like $500 or $1,000, and the contract price is $400,000, that's pretty nominal, and that would most likely wouldn't be considered a binding contract. But that it will potentially come down to like how the contracts are actually written. If you had something like placed under contract on, say, like January 5th, and then you closed on February 20th or something like that, it could potentially still fall in there. But it's super subjective. Something we'd have to look at contracts on that, unfortunately. Anything obviously that was under contract, purchased later in the year, we don't have to worry about this. And this will not be like there won't be an issue next year, of course, because we're only specifically dealing with that first 19 days of 2025. So yeah, very, very bizarre. And yeah, even if you were like doing renovations and it just wasn't like complete yet or whatnot, it still is based off of that original acquisition date.
Okay.
So, like similarly, if you closed on a property, we've had this situation come up already too. If you closed on a property in December, but then we're working on it, burring it, whatever, and then you got it placed in service in February of 2025. That one would be potentially able to claim 60% bonus on that one because it's based off of the 2024 acquisition date. So yeah, tricky stuff.
Yeah. Okay. So what if you lived in a house as your primary residence and then rented it out on January 25th?
Yeah, that's a great conversation. So that actually, we have to ask when you originally bought the house, even though it was a primary. So like if you bought it in like 2022, but then you like first place it into service as a rental in 2025, it's going to be that like January 1st, it'll be that 40% bonus rate.
Okay, it'll be the 2025.
Yeah.
Okay.
Yeah. Weird little 2.5 week window. It's very, very frustrating that they could have just made it beginning of the year. They kind of did something similar in the TCJA passed. It was September 27th, 2017. And we had a similar type of weird cutoff there where if you bought it before but placed in service after, there were weird rules around it back then as well. And we had to kind of deal with that few months of the end of the year being an issue. All right. So the next one is that we often, I don't want to say forget about, but it gets glazed over, is the Section 179 deductions. Also, the big thing on this one is the expensing threshold went from 1.5 to 2.5 million. And then also the phase out adjustment went from 2.5 to 4 million. So what I'm talking about there is the way that this works with the phase out is if you buy assets that are eligible for 179 deductions, and you buy more than 2.5 million in a year. So granted, that's a lot. You got to be buying a lot in order for that to actually happen. Doesn't typically happen with like average real estate investor. But if you go over that 2.5 million, they start phasing out how much 179 deduction that you can take.
What's a 179 deduction?
Yeah, so 179 deduction is it's immediate expensing of assets. And so it's very similar to bonus depreciation in that vein of like, okay, if I've got $50,000 of say 5-year property in this rental that I bought, I can take bonus depreciation on the full 50,000, right? And with 179 expensing, you can do the same thing. You could expense the full 50,000. So this was like something we looked at more when bonus was going down from 100%, like going down to 80 or 60. But why it's still relevant is because, you know, the obvious kind of like question is like, well, if I can take bonus depreciation, why should I even look at this? Why should I even consider this? Is that not every state conforms to bonus depreciation. So like South Carolina and North Carolina, for example, don't conform, which means that they can't take bonus depreciation at the state level. And North Carolina's rule is oddly different than South Carolina's rule as far as like how they handle bonus. But for the most part, like you can't take bonus depreciation. Now you can still take it on your federal return. You just can't take it on like your South Carolina return. However, South Carolina conforms with Section 179. So it's a weird thing. Like states can decide whether or not they want to follow the federal tax rules, or they can make up their own. So we have a lot of those weird nuances from one state to the next. But with since South Carolina conforms to 179, if you bought that property and like say do cost segregation study and you identify that $50,000 a 5-year property, and it's worth looking at to see, hey, should we take 179 on that property instead of bonus depreciation? Because then we could take it at both the federal and the state level. And then if you're investing in multiple states, I mean, it's like I said, it's all across the board as far like about almost half. I think like 23 states don't allow bonus depreciation. So I mean, there's a lot of potential out there for this. Obviously it's like most state rates are a little bit lower, so it's not like a huge concern. But it's something that's like worth looking at. There, if you're doing like specific, it gets, I won't go too much far in the weeds, but there are exceptions for commercial property. When I say commercial, I mean non-residential. And the IRS defines non-residential by not Webster's dictionary, but by their own rules. So like short-term rentals, for example, are considered non-residential property. And for non-residential property, you can take 179 deductions on things like a roof or an HVAC system, as long as you do the repair or improvement after the property's already placed in service. That's the most critical component. So if you have a short-term rental, say you buy it in 2025, cost seg, ton of bonus, you go into 2026 and you have to replace the roof. Well, normally by default, the roof has to get capitalized and depreciated for 39 years, which is rubbing salt in the wound because roofs don't last 39 years, and that's super slow depreciation. But if you're replacing a roof on a short-term rental and it's sometime in the second year or whatever, so it's clearly placed in service, you could take 179 on that roof and write the full $25,000 roof off instead of taking tiny depreciation deductions for the roof over 39 years. So that's just like a quick example. I mean, there's a whole lot of other what if this and this and that and stuff like that. But that's another reason why, like, even though we have 100% bonus, like we still want to monitor things like potential for 179 usage because it's pretty phenomenal. Makes a pretty big difference. So that's one of the things where like we can talk about things like repairs and improvements are one of the most subjective types of considerations when you're like making updates to a property, where you could have an hour, 2-hour discussion on all the different treatment and stuff for different types of improvements you could make. So I hit this one real quick. I mean, it's really cool, but it's a little bit restrictive, but I like want to include this in here. There's a new asset class that they've defined, and it's qualified production property. We're calling it QPP for short. But basically it's buildings that are used in a qualified production activity, which is, kind of have it defined right here. Production that encompasses agricultural, chemical, making any kind of products, which is like any kind of personal property, manufacturing widgets, whatever, that as long as not a food or a beverage, would fall into this QPP designation. And why it's so exciting is, again, this would be non-residential, like commercial property, right? For a property like this, which would be 39-year depreciation by default. However, if it meets all these definitions for QPP, you can fully expense the entire cost of building. So we're not talking about getting a cost seg on it and only taking like 25%, 30% towards bonus depreciation. We're talking about writing off the entire building, which is massive. So there are some sticky provisions on it. Like they did think this through to like prevent real estate investors from just easily like tapping into this. The thing is, you have to like actually like be a business that's engaged in the production. So like as a real estate investor, you can't purchase a manufacturing like facility or warehouse or something to be put into service and just rent it to an operator. You actually have to like, it's the business itself that like owns the building and operates inside of it. So we believe they keenly put those restrictions in there to keep like real estate investors from just buying like production facilities and then leasing them to operators. So that would be too easy. What we're curious to see how this works in like the partnership kind of syndication realm, though, is there very well may be real estate investors like partnering up with manufacturers to basically come in as financial partners and to be able to purchase like the building and just be a partner in like the manufacturing process. So it's kind of exciting to think that we might be entering this kind of new era where there will be some new creative like partnership structures and deals and stuff like that to in order to help real estate investors like get into being able to take advantage of this massive first year deduction. So we'll see on that. There's still writing regulations on all this stuff is the other part. IRS said that they're going to try and get all the regulations out in 90 days from the passage. So we're coming up on that here in about a month, but I'm not holding my breath. We'll see if they actually get the regulations all issued. And what I mean by that is, for anybody that doesn't know, it's like, the Congress passes the bill, then the IRS has to interpret the language of the bill, like the actual law, and then they have to write the code and the regulations on it. So we actually don't have full-blown code or treasury regulations on all this stuff yet. So there could be some things that we get more clarification on, and if like what other types of restrictions are at play in this one. But yeah, and this one does have a sunset date on here. It's going to be like from 2025 through 2029. But who knows? If the program goes really well, they might extend it. We'll see. Right. This one is really interesting. This legitimate, so excess business losses. This was an actual loophole, and I don't use that term lightly. Like loophole in that, like they did not mean to leave this hole open originally. It's the excess business loss was part of the Tax Cuts and Jobs Act, so like went into effect in late 2017. And what it does is it limits how much business losses you can use to offset non-business income. So think like, okay, I generate huge losses from my real estate portfolio and I use it to offset my W-2 income. whether that's short-term rentals, long-term rentals, whatever. And it's adjusted for inflation. So you do have to generate a pretty hefty amount of losses for this to be applicable. I think in 2025, it's the amount 624,000. So it is super high for married filing joint couples. So it is really high. Where the loophole laid was if you generated these massive business losses when they would roll over to the following year. But when they rolled over to the following year, they would become net operating losses, not excess business losses. So you could carry a huge amount over to the following year and then and have little to no limitation on those carryover losses. We really, really thought they were going to close that loophole because it was not intended to be there when they passed the TCJA. But they basically gave the thumbs up and said, like, we're going to leave it alone. We're not going to close the loophole. So that is a very, very unique kind of planning opportunity for, higher income individuals for sure. It's pretty funky. Let's hit this real quick. It's not real estate related, but EV credit terminations. We're really close on that. Like if you were going to buy a Tesla or something like that, tax credits for those are going to go away. Like you have to have it delivered by September 30th to be able to claim that credit. So that one is going away pretty quickly. Same thing with energy efficient home credits. Like this one is December 31st. Those were like, if you're putting in like energy efficient windows and stuff like that, or energy efficient appliances. So we're getting rid of that one. This was one of the quote unquote pay fors where like they created tax breaks for some of the real estate stuff. They had to give away some of the old ones, but this one was really harder to tap into compared to the other ones. So I'm personally kind of okay with it.
That's probably why we, does anybody else get all the YouTube ads about people trying to sell you?
They're pushing it so hard because they're trying to get it all in. Yeah. And very similar is the solar panel one. That's December 31st. So you got a lot of people that are rushing to try and get, solar panel installation because the installation has to be completed by December 31st. And the panels like be operating to get that credit. That being said, like I've some people that are like, well, I still like the idea of solar and you can put them on rental properties. And the IRS clarified 2-3 years ago that the solar panels are 5-year property. So they are bonus eligible. So like if you're putting it on something like a rental property, it depending on what other rationale you have for doing it, like it does have some tax benefits if even after this credit goes away. Similar on this one, I won't spend too much time on it. 179D, energy efficient commercial buildings. This one's got a little bit more time on it because the big commercial buildings, they didn't want to pull the rug out from underneath anyone's feet that had like started production, like building some of these larger properties and stuff like that. But they've got a little bit more of a runway on that one, but that one's largely going away over the next couple of years too. One thing that I'll leave that up there for a second. That I didn't get in here though too, that is also really exciting on the real estate front. But we're gonna have to wait a little bit on it, is the Qualified Opportunity Zone program got revamped. And that is huge. If you're familiar with that program, they did it starting in 2017 and it runs through 2026. It's hugely advantageous if you have large capital gain events. So we have a lot of clients that are like selling a business, or sold crypto at massive gains, sold, Apple stock at massive gains, things like that. You can roll those capital gains into qualified opportunity funds, which then invest them in qualified opportunity zone properties. The reason why I say we have to wait a little bit on it is the new program, the new QOZ program, doesn't go into effect until the old one ends. So, and the old one ends in 2026. So that means we're waiting until 2027 for the new one to start. So but definitely a planning opportunity. Like if you're looking at a situation where like sometime in the next like 12 to 18 months, you're thinking like there's going to be this big sort of like maybe liquidity event, vesting stock options, anything like that, where you think like I'm going to get hit with a huge capital gain. If you can hold off on like selling that property or selling those shares of stock or whatever the case may be, a little bit longer and hold it off till 2027, there's massive tax benefits that you could tap into on that front. Because the big highlights on qualified opportunity zones are that one, you get to defer the capital gain recognition for 5 years. And so not pay the tax bill for 5 years, which it just is beneficial for a time value of money perspective. But also, if you hold the qualifying investment in the qualified opportunity fund for at least 10 years, you get a step up in basis on like the investment in the qualified opportunity zone. So what that means is that if the property, let's say, goes from like your share, because it's being a fund, right? But if your share goes from 200,000 to 400,000 over the course of the 10-year because it appreciates over time, you could, like when the fund sells, you could get that $200,000 gain out tax-free, like completely tax-free. So kind of really quickly glossing over the highlights on that. There's a lot more to it than that, but I mean that's the big attraction. And you don't have to sell at the 10-year mark either. That's the thing is you can, the program goes to 2048, I believe. So it goes for a ways. So it's like almost like 30 years that you can hold it in there and get that step up in basis and get it all out tax free. So that's pretty exciting.
Does the step up, is the date 10 years after that, whatever value it is, then is what it steps up to, or when you pull it out?
Yeah, exactly. So like the simplest example would be if you just like owned the whole fund, which is possible. It's pretty tough to do it, but like, let's just, to simplify the example, if you bought a property and it was in a qualified opportunity zone and you have the fund set up correctly and everything, say you bought it for $500,000 and then 10 years later it's worth 1.2 million. That entire like $700,000 gain, because you get a step up in basis to the 1.2 million fair market value. And so because your basis, because your basis goes up when you sell it, you're technically not recognizing any gain.
Yeah, so it's the step up is whenever you sell it, as long as it's before 1948.
Yeah, it's 2048.
2048, yeah, 2048. Thank you.
Yeah, I have to double check. I know originally it was 2048, but somebody, our research guy, was saying that you can hold it for like up to 30 years, so they might have bumped it to a later, like 2056 or something like that.
Cool. So if somebody sells a business and invests their proceeds in the opportunity zone, they can not pay any taxes on their capital gains for that business if it's invested.
Yeah, it's a two-parter. So like initially, it's like if you sell your business and you have like $1 million gain, for example, if you roll it into the fund, you get a 5-year deferral. So 5 years later, you have to pay the capital gains taxes that you deferred. So if you got $1 million gain, it's probably going to be about $200,000 in tax. So you get to keep it for now, but then in 5 years from that date, you have to pay the $200,000 in capital gain. Then separately, like outside of that, like, cause that's the money that you put into that's going to go into like the partnership, into the fund. Whatever the fund does though, like all the money that it makes essentially, as far as like the gain on the investment from like during the 10-year hold period, that piece is the part that you get tax free. So it's like a deferral on the initial gain, pay tax on it 5 years later. But when the property appreciates over the 10-year lifespan, you get the step up on that at the tail end.
Okay.
So yeah, it's a little funky with the weird, time periods and all that kind of stuff. But what we've had is like, the question I get on that most often is like, well, if I have to pay the taxes 5 years later, like what's the point? And like one, again, like time value of money, like just real simply, if you just didn't have to pay that $200,000 tax bill, that means it's an extra $200,000 that you could stick in. Let's just say you threw it in the S&P 500 index fund, and over the next 5 years, it grows from 200 to 290. Okay, great. Extra $90K that you wouldn't have otherwise had in your pocket. Yeah, you got to pay the $200,000 bill at that point, but you also have an extra $90,000 in your pocket. So like you've almost like used the deferral period to help you pay the tax bill in a way. And if you're a really good investor, maybe you get better returns than that, and you actually generate extra returns that cover more of the tax bill than just my example of 90,000.
Yeah, I mean that's the whole 1031 exchange argument.
Yeah. Oh, yeah.
Even if you 1031 and sell it eventually, right? And not until you die, to your kids, you still.
Well, and the other really crazy thing with it is that because you are going to get taxed on the gain, like you have that in that example, the $1 million, you have $1 million of basis that is going into like the qualified opportunity fund, and it's going to do something. It's going to buy real estate or build some property or something like that. The fund itself operates just like any other partnership. There's restrictions on like what it's allowed to do with its cash and stuff like that. But as far as the taxes are considered, you can still, like, the partnership can cost seg the property that it constructs or buys and pass through losses from the fund back over to you too. So depending on what the rest of your personal situation looks like, whether you've got reps or, other forms of passive income and stuff like that, you could literally, when we've had a lot of clients that did this in the first round, like the 2017 to 2026 round of QOZ activity, is they would then get the losses from the real estate inside of the fund passed through to them, and like use reps or whatnot to like offset W-2 income, and they would actually get all the tax savings immediately, and be able to use that to pay the tax bill when it came due and at the end of the period, and actually generate a lot more, because they'd get enough tax savings to cover it. They'd reinvest the tax savings, generate even more income, and have it pay the tax bill at tail end. So yeah, even though you have to get hit with it 5 years later, it gives you just so much opportunity, especially because it literally gives you a 5-year planning window too. Instead of like normally, if you're sold a business, you just go, okay, great, it's September, I've got 4 months to do something, or I'm going to get hit with this huge, gain on sale. If with this like opportunity, again, no pun intended, it gives you a 5-year planning window to do all kinds of things over multiple tax years before you get there. So it's pretty great.
Cool. Thank you. Nick or Augusto, do you guys have any, or Aubrey, you guys have any questions for Justin?
Not right now. I did scan your QR code, so I might be hitting you up.
Cool. Yeah, absolutely. We're always bringing on new clients. We'll give you a heads up. We limit the amount of like new clients that advisors can take on at any given point in time, just because we want to make sure like everybody's getting the white glove service that we pride ourselves on. So like right now we're filling October start positions like for tax planning, but always better to be sooner rather than later, especially going into year end, if there's any triggers that you might be able to pull or something like that. So yeah, we'd love to work with you guys.
Cool. Thanks, Justin. I appreciate it.
Yeah, absolutely. Thanks for having me on.
Yeah, man. Have a good day.
Yeah, you too, guys.
Y'all take care.